Welcome to this edition of Insider Secrets, the weekly podcast that turns real estate investing goals into reality. Each show, we interview guests who are seasoned real estate professionals, actively closing and managing real estate deals. Mike is the founder of My Core Intentions and would like to help you make your real estate investing dreams a reality. Mike coaches you to buy investment real estate, creating short-term cash flow and long-term wealth. Your host and real estate coach, Mike Morawski, has more than 30 years of real estate investing and property management experience. Here's your host, Mike.
Hey, good morning, everybody. Welcome back. I hope that you are having a great weekend. I hope you have your coffee in hand, and thank the person that invited you this morning if you're new to the show. But I appreciate you listening in and being here. I think you will be excited about my guest this morning and the ride we're on in this wild world of multifamily. I think right now that the market environment that we're in is interesting. There's some distress going on, maybe a little bit more than we want to see. There's some volatility in the world, but I believe that the timing is perfect. The timing is perfect to be in front of this market shift. I say a lot. My best friend in the world tells me that you don't have to be a genius in this business. You just have to understand the market cycles. And we are switching from coming out of the down cycle. We're going to head into this new upward cycle, and we're going to start to see this market change. And if the wind is at your back and you're in the multifamily business as an operator with assets right now, if you can make it through this little peak of a storm, you're going to do really well. You get involved in assets today, whether you're an active investor or a passive investor, you're going to see a lot of opportunity and a lot of growth. Hey, if you are just following us for the first time, we'd love for you to smash the subscribe button, like us, love us, share this podcast with somebody else. Okay, my guest this morning, good friend of mine, coaching client of mine, Daniel Huffman from Atlanta, Georgia. Daniel is a home builder, multifamily acquisition operator, and in the property management space. We're going to talk a lot about a lot of that today. So buckle up and get ready for this ride. Hey, Daniel, good morning.
Good morning, Mike. How are you doing?
I'm good. How are you?
I'm doing pretty good.
Good. I know you have your coffee, right?
Oh, yeah.
Enough to be holding on to that. That's for sure.
Yeah.
Hey, what's the world like in Atlanta today?
Atlanta is a pretty good market in it. I was just watching this quarterly webinar from Market Insights, and they talk about how Atlanta kind of follows the average of all across the U.S. as far as multifamily starts, pricing, and everything. They showed a lot of different graphs from all the different major metros, and we just kind of follow the norm there. And so I'd say over the past 6 or 8 months, we've seen some softness in the space. Trying to keep tenants or gain new tenants has slowed down for sure. We've had to adjust some of our pricing on many of the assets that we're managing in the Atlanta area. And I think that's happening in a lot of other markets as well.
Yeah, I think, and we'll get into that a little bit. You said something I wrote down that I want to circle back to. But before we jump too deep in this and get caught in some rabbit hole, I always start my show by asking one question. And I'm in the process actually of writing a book called The One Word. And what I'm doing is taking the top 100 words that were said by this question and putting it into a word and talking about them. But tell me in one word, what best describes you personally and professionally?
I had one in mind, and I think I'm going to change it last minute here. I think I'm going to say love. I know that sounds maybe a little corny, but I think it applies to so many different things. To be motivated and to get up and do something that you love every single day is one of the most important things that you can do. And so I think it's super important that you love helping other people in the multifamily space. That's what you do, Mike. I think you're passionate and love that. And I love all kinds of aspects around multifamily real estate, built for rent, and different things like that. So that's what gets me up in the morning, gets me excited, and a lot of other things that I could go into where love is a huge part.
That's awesome. So I've probably asked that question 300 times, and I can honestly say that you're the second person that's used the word love. And both times it's been used within the last 8 weeks here. It's crazy. So it caught my attention. I had a woman on my show over the last 8 weeks here, over the last couple of months, and she said love, but she had a tone more towards really relationships with people and that more so that type of love. And I like what you said about it because it's more of a give back. And love what you do, be passionate about what you do. I think that that's just awesome. And boy, I have to say that probably makes the book too, because I'm going to have to say the only two people out of 500 times I've asked this question.
Oh, wow.
Yeah, I think that's great because that's one of my favorite words.
I just started this book called A Return to Love, and it's kind of what brought me to my answer earlier. It's a great book, and I only started reading it because of a reference that I saw in another book called The Miracle Morning, and it actually referenced to this book and this passage in it. And it's got some biblical references, and it's a great book. I'm about halfway through, so I encourage anybody to look it up.
Who's the author of that book?
I don't know. I have to go back and look. It's a woman, but I don't remember her name.
If you get a chance later, could you text it to me?
Yeah.
That'd be awesome. Miracle Morning is a great book too, by the way. And for somebody who is trying to put together maybe a daily routine and start their day right, it's a great place to start for sure. Hey, why don't you jump in? Let's talk to the listeners about who you are, what you do, what you're currently working on, and let's start there.
Okay, yeah. So family company, the Huffman Group, started by my father many, many years ago. He's been in and out of real estate, I guess, since like the 70s. He built his first apartment complex in Auburn, Alabama, kind of right out of college. So I've been in and out in the tech space some, and then back into real estate, did some hard money lending. And basically, I grew up around construction and real estate my whole life. So when I was old enough to come out of the job site, he'd bring me out and say, hey, this is how you shoot a level. This is how you do this or that on the job site. And he'd spend a few minutes with me, and then it'd be like, okay, son, go clean up the trash. And so then I'd have to go around and clean up the trash on the site. And as soon as I was 16 and old enough to drive, he got me a beat up old truck. And I think he may have been as excited about that as I was, so he could send me off to Home Depot to pick up materials. So long background in real estate and residential construction. And then I started, when I was younger, I started up a little trim crew on the summers, and I do trim work and new construction homes, renovation work and things like that to try to make money. And at one point, he farmed me out to work on a gutter installing crew for the summer. Like we finished up a house, and it was about summertime, and I think he wanted to give me something to get out of the house. And so he went and talked to the crew and said, hey, my son's like a great worker. You need some help this summer? And basically they just kind of hired me on. And so I went and installed gutters for the summer. And so after I got out of college, 2009, I went in for construction management. I was also at Auburn, or building science as it's also called. There was really no construction jobs whatsoever. So I came back with a family. They had started basically buying up single family homes in the Atlanta area, super cheap. I mean, we were literally buying stuff for $30,000 to $40,000 a home. And we would renovate it and then rent it out. And we had a line of credit that we were working from. And so we basically kind of just try to rotate through. We'd buy 4 or 5 houses, we'd fix them up and rent them, and then we'd take them out to some investors. They'd invest in what we purchased the home for, basically. They get a first lien, and then we pay them, back then it was 12% interest. And so we kind of rotated, and we purchased a little over 100 homes over a couple of years and kind of grew. That's where our entire kind of multifamily company grew from. And so we've continued to acquire assets since then. We were vertically integrated. We have our own property management company that manages our properties as well as third party. And then around 2016, 17, we started getting back into new construction as the market improved. And so we've done some for sale product as well as some for rent, build for rent type product.
That's awesome. I love that your dad used to take you to the work site. Okay, go clean up now. That's awesome. Yeah. It's kind of funny, though, how you were talking about the different jobs within the construction business. You learned how to trim, you learned how to frame, you learned how to put gutters up. I remember when I went into the construction business, I had worked for all of these people in 6 months for an electrician, 6 months for a plumber, 6 months for a concrete contractor. And I remember my mom getting mad at me one day going, why can't you keep a job? And about 6 weeks later, I opened up a general contracting business of my own. But I learned a lot from all these different disciplines I worked for. So kind of jack of all trades, master of none.
No, I agree. That's the greatest thing if you're trying to do general contracting is being able to do all the different trades. Otherwise, it's hard for you to manage people if you don't know what they're supposed to be doing. So yeah, you're right. I did a little bit of electrical, a little bit of plumbing, a little concrete work, and it was good.
Hey, so early on when you were talking about Atlanta, when I asked you what's it like in Atlanta today, and you were talking about the Atlanta market, you said new construction starts. And I wanted to circle back to that comment because what in your world are new construction starts like today? And I know you're getting ready to bring an asset to the market to start to go vertical on. How do you feel about where we are in the environment and being able to do that?
Yeah, so I referenced that Market Insights, which is a great company that does kind of research for builders in the Southeast. And I think twice a year they do a free webinar with some great information. They've got an economist that kind of talks the whole picture across the country, what's going on, and internationally as well. And then they have another guy who kind of digs deep into number of lot transactions and at what they sold for and what markets around Atlanta and the Southeast. He goes to a lot of different markets. They branched out to Texas and some other areas. And basically, Atlanta itself has seen a slowdown of new construction starts. New sales are down, not tremendously, but they are still down some from last year. And last year was still slower than the prior year. And so we're still seeing what they call basically a rate-driven market, talking about interest rates being above 7%. And from their research, they see that you see people start really transacting when you get to around the 5.5% mortgage rate. If you can get somewhere around that rate, you see people start moving out and transacting more, basically. They also said something else that was pretty interesting. They said that this kind of like lock-in effect that we've had, people that have got lower interest rates, is starting to burn off. And I think what's happening is that people that were on the fence and said, I'll wait it out, are tired of waiting. And so they're seeing the resale market pick up. And so what's kept the new sale market alive for the past few years is the fact that there hasn't been as many resales. And so the resale market, they say, is starting to pick up. They're starting to see more sales come out of those. And right now it's kind of in the buyer's favor as far as the market goes. Yeah. Translating to our project for Build for Rent, we have such a long horizon from when we start to when we deliver units. From my perspective, I want to be trying to start when there's not as many other starts happening. If I start when everybody else starts, like so many did back during COVID, when interest rates were low, they all kind of came out at the same time. So we've had a flooding of the market of new product, and it's been hard for them to get stabilized. And so it may be a little bit more difficult to get them started right now, but if you can get one out of the ground, I think 2 to 3 years from now, you're going to be in really good shape.
So what's the difference between, and I want to do this for the audience that's listening, what's the difference between build to rent and build to sell? Now, I don't mean fundamentally what's the difference. What I mean is when you talk about new construction starts, does it make more sense to do a build to sell or a build to rent in the market environment we're in or moving into?
Yeah, I mean, I think everybody understands the fundamental difference. I mean, one's for sale, one's for rent. You got classes of for sale assets as well as for rent product. You've got garden style apartments, you've got cottage style, small little units, you've got full size single family home for build for rent product. So there's lots of different product types within each sector. And the biggest issue that's going for sale right now is affordability. And to be honest, I think it's one of the biggest problems that we're going to see as a generation going forward is affordability of basically homes. And they talk about it, and I've talked about it a lot in the past, and this missing middle product that's so hard to get approved in the municipalities, but is really needed, is something that's between an apartment complex and a full single family home. So most people think, okay, townhomes. but it can be a lot of different things besides townhomes too. It can be small cottages, like a project that we've got approved and upcoming. And so take the same product for sale and for rent. And generally right now, your price is about $200 to $300 higher to purchase it than it is to rent it. And that differs from market to market, but how much money am I having to pay every month to be in this home? It's cheaper to rent right now. And so that's why I think it's a great idea. Built for rent's needed. It's growing. I think more and more people are realizing that purchasing a single family home as a long-term investment is not always the greatest idea. I know that many of our parents, it was their largest asset, and over time it grew, but it takes work, it takes upkeep. There's a lot of stuff that goes into owning a single family home.
Yeah, but the product that you build also, say that in 10 years from now, you guys want to sell off that asset, and a developer actually could come in, or an operator could come in and buy that, and they could do a conversion on those units and sell them off individually then, couldn't they?
Yeah, that is a great point, and something that we love and a lot of people, investors and lenders, like about built for rent. So if the markets were to change dramatically and all of a sudden it's better to purchase, interest rates are low, and maybe prices of single family homes have gone up, but the monthly price to own one's gone down, then you could convert all your units over and sell them.
Yeah. Always interesting. I remember when the condo boom a number of years ago happened, and people were taking apartment stock and they were converting them to condos and selling off condos, and people were buying them, and investors were buying them by the dozen in a building to rent them. And that build to rent building like that became the condominium boom of the mid 90s.
Yeah.
So that was interesting. I wonder if we'll ever see a opportunity like that in the market cycle again.
Yeah, I don't know. It's so hard to predict. I just think that low interest rates like we had and got used to are not going to be around for quite a long time.
Yeah. What do you see interest rates doing, by the way?
Well, it's interesting you asked. So they made a prediction in this last call, and I think it's pretty accurate. They were suspected to lower their funds rate about 200 basis points over the next year. So they're going to start aggressively lowering about 50 basis points meeting or so. But they don't suspect the 10-year to correlate directly with that. So they've got it coming down later this year into like the high threes, and then next year kind of coming back up into the 4 kind of range, not far from where we're at right now. And the reason being was they were talking about all the debt that we currently have that the federal government has that they have to service, right? As they issue more bonds, more treasury bonds, they're mostly bought by foreign governments, that basically they're becoming less attractive. And so this idea of them, the rates coming down, they don't foresee that happening. They think the demand's going to be reduced. And so the interest rates are going to have to come up in order to entice people to purchase them. And same thing, the 10-year doesn't correlate directly with the 30-year mortgage either. And so they're not predicting much lowering. They don't suspect the 30-year mortgage is going to lower 1-to-1 to those reductions in the overnight treasury rate. So they said it should come down some, but this is their prediction. And I think they do a pretty good job. They've been pretty accurate in the past. And I think they're right. I think that our treasuries are not as attractive as they used to be maybe 10 years ago.
And I think that's a really good segue into talking about raising capital and looking for that investor who would love that 5% interest rate, 4% 10-year treasury rate, secured investment, but it's not that attractive anymore. If you have inflation at 4%, even 3%, but you're making 4% on a T-bill, what are you really making? First of all, if inflation's at 4 and the T-bill's at 4, you're not making anything. You're zero. All you're doing is preserving your capital. And there was a period over the last year and a half that inflation was like 8 or 9%. And if you were invested in a T-bill, you were actually losing 4% on your money.
Yeah.
That tends to make alternative investing in real estate more attractive. I know your group raises capital for your new build assets and actually even for assets that you buy and own and operate. What types of returns can the passive investor look for or be able to say, maybe I can get this in this type of a product or asset class?
Yeah, generally, I think preferred returns are somewhere between 7 and 10%, depending on the project, and then generally higher. I mean, that's kind of your yearly cash flow that you're trying to reach, and then higher once you refinance or sell the product. We're trying to get into the high teens to 20s, depending on the product type. So when we buy existing multifamily, depending on what the plan is, if we're buying something that's cash flowing well, it's a great asset, your long-term IRR returns are a little lower versus something that's a new build, like the build for a project we've got coming up. Those returns are in the mid-20s IRR. But basically, you don't see any of the continual cash flow because we're building the asset for 2 years and renting it up for another year. Right? So most all of that comes towards the end. And you're right, though. I mean, unless you're just trying to like sit your cash somewhere until you find another real estate deal, you can make 4%. It's safe, but yeah, a lot of times you're losing money in that way. And there's a bunch of banks that got caught holding T-bills. They went down in value because the Fed kept raising rates. And that's how some of those crashes, there's a couple banks that basically went under. So if you hold a T-bill and you bought it at 3%, and all of a sudden now they're paying 5%, your T-bill's not worth the same amount anymore.
Right. Yeah, it's interesting how that whole bond market works. So in your product, when you raise capital from investors, you build your product, are there different places that a passive investor earns money in your asset? Are they investing and getting any cash flow along the way? When does cash flow start? What does cash flow look like for them? And what about equity? How does that work?
Yeah, so when I first talked to you about what we were doing with the houses, it was a debt-based investment, and we're doing equity-based investments now. So the investors do get ownership in the project. It depends. So if we purchase a cash flowing asset, an existing multifamily deal, then we expect to make distributions on a monthly or quarterly basis from that asset. Then on the other side, if we're building something from scratch, it's not making any money yet, we're just plowing money into it as fast as we can to build the asset and get it rented up. So they don't see any cash flow on a new build for probably 2 to 3 years. As we start running up, there may be a little bit that comes off, but it's going to be at some sort of event where we refinance or sell at stabilization to where they're going to see a big cash event.
So when your investors come in, are they just there for that couple year period to get the project built? Then you go in and refinance that project. You take those investors out, or do you?
Well, they still keep their ownership, but our hope really is that at refinance, we can pay everybody back their initial capital. So if they put $100,000 in, when we get stabilized, at least on our upcoming one, our pro forma states that when we pull that cash out from the refinance, we're able to pay back the loan, our construction loan, and give equity back to our investors at that time.
What do you do? A return of capital, their initial capital, and then do they stay in the deal?
Yeah.
So that's a pretty sweet deal for a passive investor on the new side, and they're build to rent.
Build to rent, yeah.
So they get to invest, not see anything for a couple of years, but at that couple of year point, they get a return of principal, and then they can stay in and continue to get cash flow along the way.
Yep.
So it's like building an annuity. You know?
Yeah, that's a good analogy. Yeah.
Yeah, it's pretty funny. I was talking to somebody the other day. They said, well, I can go make 3, 4, 5% in an annuity depending on how much money I invest in. I said to them, where do you think annuities make their money with your invested money? They go, what do you mean? I said, well, the insurance company takes that life insurance money, takes that annuity money that you put in there, you buy that policy, you invest in it. They take your money and they go invest in real estate. He looked at me kind of funny. And I said, they have to invest that money somewhere. They're going to go try to get the biggest yield that they can get. So why would you not just bypass the annuity or the insurance company, go directly to the real estate yourself and get the whole yield versus just getting a portion of the yield?
Yeah, they're lending. Like I said, I was talking to a lender just the other day who does life insurance. who's looking at our deal. So yeah, they're lending into the market. They're investing in projects, but you're right. That's where they put their money. For the most part, it's in real estate.
Yeah.
Northwestern Mutual, all these big groups.
Yeah, I remember being a kid growing up and asking my mom one time, hey, who owns that big apartment building? And she said, oh, I don't know, some insurance company. And it never made sense to me until a number of years later, I do a deal, an institutional deal with a life insurance company, and they become our private equity investor in the deal. And all of a sudden it clicked for me. I was like, holy cow, my mom was right. And she didn't know anything.
That's a good point though, man. If it's safe enough for the life insurance company, it's just about as safe as it can get. I mean, it's existing multifamily that's cash flowing, in my opinion, is one of the safest assets. It's a real asset. It's not paper that's getting pushed around. It's not a company that can have something happen and all of a sudden they got losses. It's our money, all of a sudden the dollar goes to zero. Like it's still there. It's still worth something. So you can't say that for public companies. They can go to zero.
Yeah, absolutely. Hey, so I know you do build to rent and you raise capital for that, but don't you also do some, you guys buy existing property, right? And talk a little bit about your thesis around that.
Yeah, I'd say that we're opportunistic like most people that are trying to buy multifamily. There are some good opportunities out there right now in distressed areas. I mean, just take, for instance, how we first started. I mean, that gets about as distressed as it gets, 2009. And so we see a lot of opportunities in those kinds of situations for us to come in and pick up assets at a discount, basically. And a lot of times they need work. And so a lot of times what we're looking for is something that we can use our construction background to improve the asset. And then we've got a great operational team for property management that can step in and improve occupancy and get the asset running well. So most of the time, we're not looking for a Class A apartment that's 95% occupied that was built a couple of years ago. Most of the time, we're looking for stuff. It doesn't have to be super old, but there's some opportunity there for us to create value. And that gets us in at a good basis. If there is a downturn in the market and prices come down, that still gives us some buffer room there to keep us safe, basically.
So where do you see most value today? Do you see more value in the build to rent or in the buying existing and reinventing what you're buying?
I don't know that I would pick one over the other. I think it's probably just on a case by case basis, but we put an asset under contract a while back that just operationally was not being run well. And the asset itself wasn't that old. It was built in like 2005. And there's some out of country owners that were trying to basically self-manage themselves by hiring a couple people to put on site. And after a while, it just got really bad. They had tenants. I mean, there was like 9, when we came in and took over management, there was 9 tenants who had signed a lease and put their deposit down and never made a month's payment. Not one monthly payment. And so mismanagement can be an opportunity for us to come in and improve things. And then just the asset itself, we'll look at the asset itself. Does it need a new roof? And what about renovation of units? I mean, these are all things that we do very well and do quickly. And so those are the big things that we're looking at. Build for rent, whole new animal. We're really focused on this kind of cottage style build for rent, which is this upcoming project's got basically little small single family homes and duplexes. We've got the full range of unit types that you'd see in a garden style apartment. So we've got 1 bedrooms, 2 bedrooms, 3 bedroom units, broad range of rental prices. And it gives people a side yard, or they're centered around green spaces. We're really concentrating on trying to create, I'd call kind of like new urbanism type of developments that make things a little bit more walkable. You get to know your neighbor. You got some green space. You can walk your dog out in front of you. You got a little front porch off your unit. It's got a full set of amenities. So we'll have a clubhouse and a pool, fitness center, all those kinds of things as well. But you don't have somebody that's living above, below, and beside you. So you get rid of noise. If you got a dog, you can walk them right out your door to your yard. Even some of them have their own fenced in side yard. We're going to have a little dog door there. They can let their dog out while they're gone, go to the bathroom, and come back in. So there's a lot of advantages to this new build for rent type. It's not a full 3 bedroom, 2 bath home. that's going to have to rent for $2,000 or $3,000 a month. We can get 2 bedrooms that are under $2,000 per month, and 1 bedrooms that are like $1,500-$1,600 a month in this market we're in. So something that's very affordable, but it's a much better product than they're going to see in many other places. I think that the product is not going away. It's going to continue to grow. Of course, it's going to be in suburban areas. This is not something that's going to be in your inner like city core, those kinds of areas, because of land price and other things. You're going to have to go vertical to try to get more density. But this type of unit type, we're getting anywhere between 12 to 14 units per acre. So it's pretty dense.
Yeah, that is pretty dense. Well, that's awesome. And now Huffman Group itself, you guys do all your own construction, you do all your own management, you are totally vertically integrated, your company?
Yes, that's true. So at least up until now, we've built all of our own projects and now the GC license. We put some guys on site, and we've got great subcontractors and people that we work with in the markets we're at. And we feel like having that control through the entire process. And also a big thing that we do is we typically don't purchase land that's already been zoned. So we like to try to go directly to an owner and put a piece of land under contract, go through the rezoning process, and basically get that upside that somebody else would typically try to take that was going to resell the property. So on this last one, we put it under contract and spent 8 months taking it through the zoning process, getting a site plan done, putting the whole kind of project together and getting it approved. And that gives us a basis in the land that's extremely low.
Yeah. So you bring more value to it that way. So that's awesome. What would you tell a new investor today coming into the market on the private side? So the passive investor, the investor looking to invest in real estate, but doesn't want to build himself or take care of day-to-day activities. What would you tell that investor today?
Yeah, I think like we spoke before, there's opportunity and distress. And so I think right now is going to be one of the best times over the next year or two to start new construction projects. There's so few being started that you're going to be one of the few that's coming up when you're done. And because it's got a long life, there's a long period of construction. You're still 2 or 3 years out before it's done. Some people see more risk in new construction versus an already existing asset that's cash flowing, but your returns are much higher. So if you're okay with not receiving a monthly check for 2 to 3 years and putting that money away, it's a great investment. We love putting together new construction projects. It's something that I'm super passionate about. We get into all the details of the site planning, everything with some great architectural teams and city planners to try to create a great product. Cedar Walk was the one that we finished last year. It was 47 townhomes. We got a website. That project rented up really well. Some beautiful townhomes. Cedarwalk.info is a website for that one. It's in Carrollton outside of Georgia, the west side. It's better than stocks.
Hey, that's funny you said that. I did a webinar earlier this week with a group that raises capital. And the whole webinar was based on that premise that traditional stock and bonds is not the place to be today. There's a bubble. The S&P is too high. It's overrated. And when you start to see those fundamentals, people start to draw back from the markets and look for alternative investments. So putting some money with the Huffman Group in an alternative investment could be the next move or a good opportunity for people. But I like the comment. You made a comment that made me think it's risk versus reward. You don't get that early payout on the new build stuff, and the returns are higher, but it could be a little bit painful along the way for a couple of years, but the returns are higher. Daniel, how do people get a hold of you if they're interested in talking to you more about your group, what you guys do, possibly even investing with you?
Yes, our website, huffman.group, talks a lot about our company as a whole. You can submit a form there and we'll reach back out to contact you. I'm on Instagram at d.huff. You can direct message me there and we can go back and forth and talk some more about some of our products and get on our email list. We send out projects on a regular basis that we're trying to raise money for.
Awesome. Well, listen, I appreciate you being here today. And any closing thoughts or comments?
Well, you're thinking about stocks, and People talk about investing in like the S&P over a long period of time, 10 or 20 years. And I just think that if you're in something for the long term, you can generally get more trended returns. But stock market is so up and down from year to year and volatile that it can be dangerous to pull money back out. And so real estate to me is a long game. I mean, we hold our assets we've got some that we've held now for 15 years or more. And you just continue to see increased returns the longer you hold. And so in the long term, the sooner you can get into real estate, the better off you're going to be down the road.
100%. I couldn't agree more. Well spoken. Hey, thanks for being here today. I appreciate you. I appreciate what you guys do in the real estate world. And I would encourage people to reach out to you. I'm going to move you to the back room. If you hang out with me for a minute, I'm going to say goodbye to everybody. All right?
All right. No problem. Thanks, Mike.
You bet. Hey, everybody. Thanks for being here this week. Hope you picked up a couple of gold nuggets this week. I think there was a lot talked about. We covered a lot of ground on a bunch of different topics. So if you're looking for a place to participate in real estate as a passive investor, you like new construction, you like existing construction, reach out to Daniel. He's got some opportunities. He'll give you some insight on some market returns. Hey, I just want to remind you that our main sponsor for today's show is Sync VA. If you are somebody who's looking for a virtual assistant and you need somebody to help you support maybe on your transaction team, maybe on your property management team, maybe an executive assistant, whatever you need, reach out to Sync VA and they will help find you somebody that will meet all of your needs. Hey, thanks for being here. Look forward to seeing you next week. Have a great week and a great weekend, everybody.
Thank you, Mike, and thank you for joining us for another great episode of Insider Secrets. As always, Insider Secrets is brought to you by My Core Intentions. Wherever you hang out on social media, you will find Mike and My Core Intentions. Please like and follow us to get the most up-to-date real estate investing trends. Visit mycoreintentions.com, where you can get expert coaching on all things real estate investing and property management. If you're looking to become an expert, Mike's coaching will help you scale your real estate investment business. We're looking forward to having you back again next week for more Insider Secrets.